Hi, I'm Jonathan Shine with National Real Estate Investor, and we're at the National Net Lease Investment Conference in Chicago. And we just had our State of the Net Lease market, and one of our guests was Bill Kahane, CEO, President, and Director of American Realty Capital. Bill, welcome.
Good morning, Jonathan.
And I want to thank you for getting out of New York this morning. It is November 1st, right after Hurricane Sandy, and it was gracious enough to join us here in Chicago. And first of all, I'd like to ask you, what do you see as the state of the net lease market today?
Well, we are through a series of investment programs, all public, two traded, two non-traded, very active buyers of net lease properties. In fact, in the last 18 months, we've acquired over $2 billion of properties in those programs. What we are seeing is extremely favorable cost of debt, even though we use it sparingly, and we're seeing cap rates still for strong credits hovering between 7.5% and 8%.
Are you market specific, product specific? Where is this $2 billion line?
Our focus tends to be retail, freestanding, single tenant, credit, net lease, long duration. We do buy some industrial distribution, no manufacturing, and we do buy some office, but sparingly. Less than 9% of our portfolio is in office. Geographically, we're in over 200 markets and over 25 industries.
25 industries. Do you see any changes in the retail market that might give you pause for change?
Well, some of the merchants are growing more slowly. The pharmacies, for example, CVS, Walgreens. On the other hand, we're seeing newcomers to the space. The dollar stores, Family Dollar, Dollar General, are stepping up their activity in terms of rolling out more stores. So there's a nice balance there that we're seeing.
Do you think the dollar store and that type of concept is basically based because of where we've been in the recession?
I think in part the attraction of strong brand at low prices that are convenient places to shop rather than the large mall, for example, or the superstore has a certain amount of attraction in this economy, but I think that business concept is clearly here to stay.
Now, regarding these 200 markets, is there a particular demographic that you're looking for? Is it metropolitan area, suburban, exurban?
We tend to look for growth in the market, but we tend to drill down as well. So our real estate investigation or due diligence will include everything from population growth, per capita income growth, to traffic count, same-store sales, for example, competitive sales. All of that goes into our decision calculus, but we do buy in secondary and tertiary markets.
Now, previously mentioned Hurricane Sandy and that you were able to make it out, and I noticed that one of your products is investing in New York City commercial real estate. This is not a paid political advertisement, but based on what has actually happened in the last week and the devastation that we've seen, how do you see that as a formula for moving forward?
Well, remember, first and foremost, Jonathan, I am not a grave dancer. We are in the city of the grave dancer. But Sam Zell notwithstanding, our attitude in terms of investing in New York City, which we began actively to do about 15 months ago through one of our public non-traded programs, was to look for the opportunity to play the recovery of the U.S., which is slow, but we think relatively certain, through the bricks and mortar of Manhattan. It tends to be, Manhattan and its surrounding boroughs tend to be an economic bellwether to kind of lead us out of the recession. There we look to growth in rent off a low base, improvement in occupancy off of some tenant failure, and a play on cap rate and replacement cost. The fact of the matter is this setback, and clearly the 24 hours of storm will leave months of devastation before we get back to any kind of approachable norm. But it'll provide us increased opportunity to buy well and accumulate assets. Today, we own 15 buildings in Manhattan, all purchased in the last year and a quarter, at cap rates between 6% and 7%, so historically high when compared to a typical mean cap rate in Manhattan of between 3.5% for some multifamily, up to 5.5% for office and some industrial distribution. But the fact of the matter is, we should be able to accumulate assets at below replacement cost, which will provide us long-term competitive advantage when the economy rights itself and this market settles in.
That's very, very interesting. And as a follow-up, in closing, when you invest in New York City, you're looking more in the office market as opposed to the single-tenant, standalone retail product.
Right. We don't buy, really, there is no such thing, frankly, as standalone retail.
Right.
We do buy a lot of retail condominiums.
Oh.
And those strike, a very profound similarity to our single-tenant net lease programs. Different tenants, but in the greater metropolitan area, we do own Walgreens, we do own CVS. Not freestanding, we own the condominium interest in what might be a high-rise office building, Starbucks. But we also like non-credit. We like parking, because parking in New York is scarce as hen's teeth, as you know, being a New York resident yourself.
Absolutely, and I'm looking forward to getting back. Bill, I want to thank you for participating in the
Pleasure,
National Net
Jonathan.
Lease Investment Conference.
Thank you.
Thank you.